A lot of times when it comes to like an industry that you just want to follow really closely, a big thing that you're trying to do is not just come up with a stock pick, but also like really understand, that space. Because if it's your job to be a biotech expert or a software expert or a semiconductor expert or whatever, it's actually kind of more important that you know the details and fundamentals of the company than it is that you pick stock. Now some of us are trying to just make money, and that's fine. In which case my approach you should probably shift it a little bit. But my approach is not only just to make money, but also to really be an expert in the space, which is kind of a more amorphous and abstract goal. And I found over the years that, try to serving both goals kind of helps. It certainly helps, to be more thorough. You can't hurt your investing. It's definitely a good thing. You don't have to be that thorough to like figure out what the main issues of a stock are. Like a lot of these little drugs for Amgen, they're not going to make much of a difference. They're pretty minor details. In a world where you want to get hired, or you want to have a lateral kind of career opportunity, it's good to know every detail. Yeah, TA is pretty cringe to me too, but I'd also not knock the way people make money. If that's the way they profit, then who are you to? If somebody's profiting trading with astrology, so be it. It's not your business. Let them do it. But the thing is, like, if you know a space really, really well, you don't have to be a good trader to make money. You might try to trade and you suck at trading, but every drug in the whole drug industry. Well, that's valuable. That's really valuable. You can get rich a different way. And maybe you hook up with the guy that really knows how to trade and you're his analyst. That's fine. What's wrong with that? Plenty of money to be made in any which way. It's not just about return. It's a lot of things that go into being a good investor. I don't trade bonds, but I'm going to start just because I want to make sure they're good for Goodell. Patience and ability to change your mind, and ability to have conviction, which is the opposite. Part of being a good trader is your max drawdown. That's the most important thing to an investor. What is your max drawdown is the critical question. Another one is, what is your annualized volatility? I think for me, the lesson is about, and I'm surprised I'm still learning lessons, 20 years investing professionally. I guess the lesson is about, what do you want your portfolio to accomplish? Right? Like, that's ultimately the question. Because at a certain point, what you're going to get with your positions. What's risky and what isn't. Now some people still have to learn that part. But for somebody like me, I know what I'm signing up for. Like, there's no surprise, that when you leverage, you could get smoked. And so, the question is, like, if you ask yourself, what do you really want out of your portfolio? Everyone wants gains, of course. No, that's easy to do. Who doesn't want gains? The question is, what do you want vol-wise and drawdown-wise? Right? At Millennium, for example, they've had these good returns, great returns, kind of the best returns. 20 years, only one down year. Not eye-popping in terms of average was 12%, but almost no downside. So the question is, what is the maximum amount you're willing to lose in your account? And if you say, I'm willing to lose it all, do you really mean that? That's the question. Is that actually true? Because let's say, in my case, you turn 100K to 2.5 million. Do you really want to lose the 2.5 million? Is that okay? And my philosophy is, this is a YOLO portfolio, so you got to keep YOLOing. But then the question becomes, is it really a good idea? Now, again, I'm in a different position from a lot of people, but even for me, I've seen billionaires cry over 100K. But But it's still like, keeping your wits about you is one of the hardest things to do investing. Oh, there's a lot of ways to cap that loss. And yes, it takes a lot of work to get there. Even if it didn't, even if you just shorted some meme coins on leverage and made 30x, okay, now you're sitting on some numbers, say 5 million. The question becomes like, you have to keep your wits about you to say, hold on, let me take my money off the table. I don't want this risk. I don't want this level of risk.
It's a lot of $30 billion software companies. And yeah, exactly. If you look at the richest people in the world, there aren't that many traders. Now, there's some interesting academic literature on this that I think Nassim Taleb, of all people, he stumbled upon this idea of like who makes more money. And there's kind of a risk, if just because you have this like, one distribution that's like this, one distribution that's sort of like this, this distribution is not necessarily, you see more of the entrepreneurs and then you see more of the investors. But, the AUC, I don't know if I even draw this really well, but the returns of the investors can actually be higher. They can actually get more of the money. Maybe there's some shift here, like it's more of a here, and then this is maybe where, okay, so here's the mean, and then we'll do the investors in green because they have all the money. So yeah, just assume something like this, and then we'll do the entrepreneurs in red because you go crazy being an entrepreneur. So you see more people making billions here, but the actual area under the curve, integral of money is with the investors. So, it's just one way to think about it, at least. So it looks like, Bill Gates, who extracts more money out of companies, investors or founders. And a lot of people have looked at this and it's actually the investors. But again, the investors do have to share it with their investees, who are typically, limited partners and things like that. I think I've found in my life, like throughout finance and business, that one of the biggest things I've underestimated is just how bad people want to make what's, to me, I guess, like a small amount of money. Because I think big, and I've always thought big ever since I was a kid. And so when I see somebody like willing to sacrifice all of their morals, all of their reputation for $100,000, it doesn't compute to me. But, people are willing to do that for 100,000, a million, etc. And to some extent, everyone has a price where they're like, we'll get everyone over for 10 million. Now I'm like, well, no, but is there another zero or another zero?
What's your number?
I don't know. It would be $1 billion or more, I think. But I think that the problem is, what I've noticed in crypto and in life is that number is astonishingly low for people. And like you saw the 𝗥𝗢𝗢𝗚 thing where she trusted some people and the number for those people was like nothing.
For a company growing revenue 40%, that's crazy. So if your revenue grows 40%, how fast would your cash flow grow? Pop quiz for you guys. Revenue is, say, X, and it's going to be 1.4X. You have some kind of cost Y. Well, cash flow and earnings are the same thing. So you have some cost Y that's going to be something like let's just say Y prime Y. Right? We don't know what Y prime is, but we presume it's going to be less than 1.4. Let's just make it Y prime times Y. That's a little easier to understand. We don't know what the rate of growth of costs is, but almost every business, the costs will grow less quickly than the revenue, right? So what will earnings or cash flow, which we'll call Z, what will be Z prime, if you will, of Z? It depends, obviously, on almost completely on the Y prime, right? But let's say it was cost grew 20%. Okay, so what would the earnings be? Well, if it was $1 billion, then it would be 1.4 billion here, 1.2 billion here. Well, let's say it's half as much. So this would be $500 million. Say that it looked like this, and then 1.2x on 0.5 is obviously, we could do that in our head, but we'll just put it down here for proof. 0.6. So 1.4 minus 0.6 is 0.8. So that guess was really good. In this circumstance, it was 60% cash flow growth. So the point is 40% revenue growth, and they did 45% last quarter, resulted in 60% earnings growth. What if that happens 2 years in a row? Okay, so the cash flow is 2.1 billion, and you're talking about 60%. Let's do that times 2 years is 32 times cash flow. That's a lot more reasonable. That's why these growth stocks are so exciting. And you could have known this yesterday. Yesterday, it was not hard to figure this out. Yesterday, the stock was 380. That would have been 24 times earnings for maybe the fastest growing company on the stock market. So yeah, everyone's talking about the right things here: operating leverage, contribution margin, all that stuff. And you're getting this big boost. So a lot of people kind of just don't understand, Palantir's growing cash flow 100% year over year. So, these ultra high growth stocks, yeah, look, people want to take them down a peg. So you can investigate them, and maybe there's something there, maybe there isn't, but just on the basis of revenue and the basis of, earnings, you just have to see that. Look, one of the things I've also said over time, I hope you guys have picked up on, is anytime the second derivative of revenue growth is positive, that's a really special company, because almost every company, as you get bigger, your growth rate should slow down just because the laws of large numbers. When I noticed Google's growth rate accelerating in 2006, I just started my hedge fund, I was looking at Google, and the company was growing faster as it grew, which is really strange. That's happening with Palantir, that's happening with AppLovin, a couple other companies. It shouldn't last too long, right? Otherwise, the company will grow to infinity. But when you see that happening, it means something pretty special is going on. And again, it says nothing about the actual business itself. We have to do deep dive into the business. We're assuming it's a normal company. We're assuming there's no fraud. We're assuming there's no chicanery. We're assuming there's not going to be some big sea change in buying patterns or something like that. Well, the rate of change is 44%. But the second derivative is the rate of change, which is positive. It's gone up. It's growing, check. It's growing faster than before. So it's accelerating. So in calculus, it's second derivative. Yeah, second derivative. So it's accelerating. And yeah, maybe there's something fishy going on with AppLovin. I'm not saying there isn't, but for now, the stock doesn't look that expensive if they continue on this path. And again, sometimes when you're debating whether or not a company is going to continue on a path, if they're actually growing faster every quarter, that's really a good sign that they're going to continue on that path. Well, ROIC is just something you're imagining. Is this a company that's going to grow
Order cancelled.
their business with new projects? Probably like Elon would have the highest ROIC. In business school, you learn ROIC versus WACC. But, companies like Procter & Gamble and Coca-Cola can actually measure
Order filled.
their expected return very carefully, whereas it's kind of extremely hard to do as a big
Order
business.
filled.
You don't know if a big product's going to be a big
Order
product or not.
partially
It's kind of
filled.
very hard to determine that. Haven't looked at Reddit in a minute, but I could take a glance
Order
at it.
filled.
I missed the car trade. Central African Republic issued their own meme coin. How crazy is that? Okay, so next steps for Intuitive, just basically have to look into the products a little more. Is there a pipeline there? There's tons of applications of straddles. You can sell straddles or buy straddles. You have to look at the vol price. You want to print? Let's look at an actual example. Okay, let's look at the IonQ equity Oman on your terminal. Okay, these are the calls and puts for the stock. The stock's at 39, as you can see. So what I'm going to do is I'm going to go to 39s. Okay, and the last sale is $1.39 and $1.40. Yeah, that's right. Looking at my other screens, those are the correct prices. So the straddle here costs $1.40 plus $1.40. So that's what, $2.80 or $2.79, right? So, okay, so if I wanted to put this in an Excel, I would say the following. Straddle premium is 280. Underlier is 39. Okay, so if the stock doesn't move at all and it closes at 39, well, the 39 calls, which cost me $1.39, are worthless. They're worth nothing. And the 39 calls, puts, which also cost me $1.39 or $1.40, and the stock stays at 39, they're worthless too. So a really nice thing to sell this expensive straddle. But I don't know if the stock's going to stay at 39. This is a really volatile stock. But we could say the straddle costs 7%. So you can go long the straddle, or you can go short the straddle. If you think there's going to be a lot of volatility, you might want to go long the straddle. For example, there's only a few days left until this straddle expires. But let's say the stock goes up 8%, okay? So let's pretend that happens, or say 9%, okay? So if the stock goes up 9%, it goes to 42.51. The stock has been at 42.51 before, so maybe it'll happen again, I don't know. But will it happen by Friday? Well, in this case, the 39 call is just this minus 39, right? And that's worth 351. The 39 put is worthless because no one would want to sell the stock at 39 because it's a 42.5. So you have the right to buy the stock at 39. Well, the stock's at 42.5. That's a pretty nice right to have. And that right is worth exactly $3.51. The problem is you sold the straddle for 280. And now it's worth 351. So you lost 71 cents on your investment of 280. So you have 209 after putting down 280. You lost 25%. That's a huge move for a few days. Now, if you sold the straddle well, you could have collected, like I said, 100% as your maximum gain because you sold it for 280, and you didn't owe anything at the end. Let's say an intermediate situation, stock goes up 3%. Well, again, the put is worthless, and the call is only worth $1.17. So you made $1.63. You made a nice profit here. You made 58% on your money in a few days. So the stock can still go up. It just has to go up or down less than the straddle amount that you paid. So imagine if the straddle premium is $20. Well, this is really easy. The stock's not going to go up or down $20 in the next 3 days. That would be a great straddle to sell. Or how about if the straddle was 1 cent or 2 cents? Well, I'd buy that straddle without even knowing what the stock is, because if the stock's going to move, this is a really easy play. Now, no arbitrage applies here. All the players in the market know what the historical volatility is. A lot of smart people like you or me, maybe just me, are thinking about what the volatility will be in the future based on news and events and things like that. So, we're trying to figure this all out. So mostly, none of these are going to be like automatically cheap or automatically expensive. Now, it might jump out to you that there's an opportunity, and then you should take it. But it's not like there's a free lunch anywhere in the market, in options and anything else. Well, the first tip I give you is that people like me don't want people who will learn from them. I want you to work and provide value for me. I'm not trying to provide value for you. I don't care about you. I care about you working for me and making me money. So don't approach somebody and say, I wish I could learn from you, because that's just you're not thinking about it correctly. You're supposed to be providing value everywhere you go to work, not, oh, I get to learn. You're going to learn by osmosis, but that's not a sales pitch. Yeah, so collar is pretty simple idea. A lot of executives do the collar. So when you have a stock, typically your payout looks like this. This is break even, right? This axis is stock price. P&L goes up and down, right? So this is, say, up $1 million, and this is down $1 million. Okay, and this is the stock price. So let's say this is IonQ, and the stock's at, say, 39. Well, right now you're breaking even, but every dollar it goes up, you make money, and every dollar it goes down, you lose money. Makes sense. Now, let's say you want to sell a call. Well, you basically say, I don't want this upside. So even if even if the stock goes up, I'm not going to get this upside. It's kind of been sold off. I've sold the call. Now I do get, of course, a premium for that. But let's say I sell the premium to buy a put. Well, I get the same thing here. I get limited downside. So I get this new P&L curve, bolded a little bit here. And the old P&L curve is in dotted lines. And many corporate executives, including yours truly, have used collars to basically say, look, I'm locking in, I make a little bit of money. I make the same amount of money really until 45, but after 45, I don't make any more money. And below 39, I lose money until say 35, whatever the symmetrical number is, but I don't lose any more money. I'm locked in at 35 no matter what happens. So this is called a collar, and Wall Street sells collars quite often. Depending on how the collar works, you could, if you buy a collar, you can reduce your margin requirement, things like that. The market works a little differently than I think people think. Like, a lot of people think that it's just a sea of buyers versus a sea of sellers, like a tug of war with the rope. And you got 10 people tugging on one end of the rope and 10 people tugging on the other end of the rope. And that the hope is that, you have more people tugging on the rope from your side than on the other side. That's not really how the market works. Microsoft has had this weird research unit for a long time. I know somebody who ran it, actually. So it's not really new for them to do weird experiments. They've done DNA computing. So in any event, the tug of war is not really the point of the market. It's about prices, marginal prices. So if the baggies jump in now, and then they sort of do their thing, they put all their money in, and then the institutions say, oh yeah, these are way overvalued. And even on 100 shares, if they knock the stock down 10%, the baggies kind of realize that they've been had. So the price discovery mechanism is kind of independent of how many people try to jump in. The marginal buyer and seller will always set the price. And the retail space runs out of people to defend their positions. And in institutions, you can kind of sit there and defend your position with huge amounts of money. Retail just doesn't have that kind of longevity for a number of obvious reasons. So you almost want those guys to come in and buy as much as they can. I know that sounds a little counterintuitive, but that doesn't worry me at all. If Fidelity came in and said, I need to buy as much as I can, different story, right? That's a totally different story. But that's not what's happening here. It's just creating kind of more victims who will have more immediate regret. So I don't think it's really kind of something that's a problem. Yeah, 𝗲𝗏 behaved pretty well. They more or less were all adults by it. The only person that wasn't an adult about it was 𝗥𝗏𝗡, who's still clinging on to some weird belief that he's going to make some money somehow. Yeah, at best you're getting good entry liquidity. Hedge funds are oh, thank you, short another million shares. And then once retail's out, it doesn't take much capital to drop it back down again. And then you have retail kind of giving up on it. So I think it almost is a catalyst. It's every big tech company has a little quantum project that's just a little kind of fun for them. I think Microsoft probably saw the Google stuff and they're oh yeah, we got a couple guys working on that too. Yeah, I think once you see a quarter or two of revenue, especially Rigetti having no revenue, it's okay, this isn't a hot space. This is a cold space. I wouldn't say there's infinite loss potential in shorting. Yeah, I like Satya a lot. If Satya comes out and says he loves quantum computing, that would mean something to me.